Hey YouTube, welcome back to My Financial Focus. In this video, I'm going to be talking about Autodesk, which is a business that at the moment has a stock that's tumbled from $303 all the way down to $250 after the earnings that they announced a couple of days ago. And I'm thinking that as value investors, this might present us a good buying opportunity. So in this video, I'm going to be doing an intrinsic value analysis of Autodesk, and I'm going to do that by looking into their annual report and going over some of their financials, and then lastly doing a discounted cash flows analysis using their cash flow statement and some of their current financial numbers. So if you're new here, be sure to leave a like on this video, and let's get right into the video. So for those who are watching this video who don't know, Autodesk is essentially a global leader in 3D design, engineering, and entertainment software. They sell customers powerful technology services and software that help with architecture, construction, and digital media. Autodesk helps their clients by creating products that visualize and basically simulate real-world application of projects earlier in the design process. So we can see right here, they're basically a software as a service company that provides products and services for companies in the architectural sector, industrial machinery, transportation, and also in animation, as we can see right here. Also, their digital media products allow for digital sculpting, modeling, rendering, and video game development. And like I said before, one of their biggest sectors is in architecture. And so we're going to get into why that may or may not be a good thing for Autodesk moving forward. I'm going to go into their annual report now, and I'm going to start off on page 82, which essentially shows us their marketing and sales strategy. Essentially, what Autodesk is doing at the moment is they're selling most of their products to distributors and resellers. So about 69% of their total revenue comes from selling to distributors, and 37% of that comes from one distributor, which is Tech Data Corporation, and then the other 10% comes from another distributor known as Ingram Micro. So that obviously poses a couple of risks for Autodesk because their revenue is so heavily dependent on one distributor. But besides that risk, there's also the risk of just them not being able to meet the demand to create products that provide enough value in the technological sector, which is obviously an extremely competitive environment. So they're going to have to continue investing into research and development in order to continue to innovate and remain relevant in the technological sector for their business and their clients. Also, the last risk that I wanted to point out here after reading through these is that a substantial portion of their revenue not only comes from two distributors, but it also comes from a very small portion of their products, particularly in the architectural and engineering sector. So if they don't diversify out of simply just engineering and architecture, that could present some risks to their revenue in the near future. Also, on page 109, we can see a look at their stock performance relative to the S&P 500 as well as the Dow Jones US Software Index. We can see that Autodesk has definitely outperformed the overall market. So anybody who was holding on to Autodesk during that time period has definitely seen pretty substantial returns. But as I said right now, the stock recently, starting at mid-November, it plummeted quite a bit, so this could be a buying opportunity, but we'll have to see with the intrinsic value analysis later in this video. And then lastly, on page 11, they talk about their growth strategy in the future. They're primarily trying to ride the macroeconomic shift away from on-premise perpetual licensing business models towards cloud-based subscription-based models. And they're also trying to form stronger, lasting relationships with clients by providing innovative solutions oriented around 3D modeling for engineering and animation. So now I'm going to get into their financial statements, and the first page that I'm going to go to is page 128. Right here we can see that their gross profit margin for 2020, the year ending January 31st, 2021, came out to be 91%, so that's a pretty substantial gross profit margin. And then their net income came out to be about $1.2 billion, which is up from $214 million at the end of 2019, and then up from a loss in the year ending 2019, so 2018, of about $80 million. So their revenues are definitely increasing, and obviously that's going to have a positive impact on their stock price moving forward. Next page that I want to look at is page 137, and this is basically just a quick glimpse at their income statement. We can see that the majority of their revenues come from their subscription products, and that's mainly because they're shifting their focus away from license models, as I said before, towards a more cloud-based subscription-based model, so that they can get that reoccurring revenue stream each month and then grow their product line and their client list easier, because they'll have reoccurring revenue and that'll have more of a positive impact on their revenues. We can also see that their operating expenses make up a pretty substantial part of their gross profit, and that's mainly because of all the investments they make into research and development and marketing. And then lastly, their net income is growing pretty substantially, as I said before. Right here, we can see their balance sheet. And we can see that cash makes up a pretty substantial portion of their total current assets, which could be a good sign because it shows that they're highly liquid, so they have a good cushion in the case of a macroeconomic downturn. But it also could mean that they don't know how to properly allocate their cash at the moment and that they can't capitalize on any opportunities. So it could be a good sign or a bad sign depending on certain perspectives. Their total assets relative to their total current liabilities has definitely grown over the last year or so. We can see that their total assets come out to be $7.2 billion, up from $6.1 billion. And that's obviously had a pretty substantial impact on their total equity, which has increased from a negative $139 million up to $965 million. So it's always a good sign to see that a company's cash flows and total stockholders' equity is increasing. And then lastly, right here, we can see their cash flow statement. As of right now, their operating cash flows have obviously increased pretty substantially, and that's mainly been as a result of them increasing their client base as well as producing products that are providing a lot of value in this market. Also, their net cash used in investing activities for the year ending 2021 came out to be $403.9 million. And that was mainly through investments in marketable securities. So they're obviously trying to invest the cash that they're bringing in so that they're not just sitting on it and it's not just collecting dust, losing value to inflation. And then lastly, the net cash used in financing activities came out to be about $1 billion for the year ending 2021. And that was primarily due to repurchase of their common stock and repayments of their debt. And we can see right here that they have been repurchasing common stock quite a bit over the years, so that's obviously going to decrease the amount of dilution that shareholders are holding on to throughout the years. And then the last thing that I want to look at is page 155 before I do the intrinsic value analysis, which essentially shows how their revenues have increased over time due to their architectural, engineering, and construction products, as we can see right here, which make up a pretty substantial portion of their total net revenues. Also, their net revenues by geography show that about half of their revenues come from the US and other American regions, whereas the other half comes from Asia and Europe, as well as the Middle East and Africa. So obviously, being diversified in terms of their revenue sources poses diversification, which leads to less risk. So I definitely think that for Autodesk going forward, making sure that they're growing their international revenues is going to be pretty important for their future revenue growth. And then through their indirect sales channels, which is selling through distributors and resellers versus just selling through their website, we can see that most of their revenues come from selling to distributors. And that could obviously, like I said before, pose a potential risk, because if they don't maintain strong relationships with their current distributors, and that could obviously have a negative impact on their revenues moving forward, unless they start prioritizing selling their products in-house more. And the last thing that I want to do is do a discounted cash flows analysis of Autodesk. So I got some of these values from Yahoo Finance, the first of which is the projected future growth rate for the company. So we can see right here, it comes out to be about 29%. And then for the years 6 through 10, I'll just be conservative and slice this number in half for their growth rate, but we can go back and play with that to see what the intrinsic value would be for different values. The year one free cash flow I got from TradingView, which showed that it came out to be about $1.35 billion. For the net cash minus net debt, I got that from Yahoo Finance, and they actually currently have more debt than they have cash. Stock ticker is ADSK, and then the shares outstanding came out to be about 219 million shares. So after plugging in those values, we can see that the intrinsic value per share for Autodesk at the moment comes out to be about $219 based on these growth rate assumptions. And that relative to the current share price still puts Autodesk at a bit of an overvaluation. But let's say that we kept the growth rate constant for the next 10 years. That would mean that Autodesk is currently trading at about a 30% margin of safety. So taking on the risk that Autodesk would be able to hold on to about 30% per year growth rate, that would mean that their intrinsic value per share comes out to be about $358, and that at the moment Autodesk present a good buying opportunity. But obviously maintaining a growth rate of about 30% is a lot to ask, but it's possible with tech companies. Obviously a 50% margin of safety would come out to $179, so that would be more ideal. But at the moment, I definitely think that because of the shock to the market with the earnings not meeting expectations recently, I think it could potentially pose an interesting buying opportunity. Obviously, before that happened, year to date, Autodesk was up about 22%, and now it's down negative 6%. So it could present a good buying opportunity or not, but I would definitely love to see what you guys think in the comment section below. Let me know if you guys are holding on to shares of Autodesk and what you guys think of Autodesk moving forward as a value investment. If this video provided any value to you guys, be sure to leave a like and subscribe to the channel if you guys haven't already, and I'll see everyone in the next one.